Okay, folks, welcome to Market Wrap for Monday, the 14th of March. Okay, so we opened up a couple of new trades today. One was Goldman Sachs, the other was Meta, Facebook. And the reason was, because I was asked about this, is that the implied volatility, meaning the historic volatility of the options, are very, very expensive. And as you can see on my list here of IV percentile, this is a measure of the historic value of the options relative to prior history. Usually a read above 50% means that the options are expensive. When you see 100%, 90%, 80%, they're really inflated. So the question becomes, why? Why does that happen? Well, normally, like you see here in blue, you have an event coming up, earnings. That's DG, that's Dollar General. And normally when you have all of these companies, these are all S&P 500 stocks, trading above 50, usually means we're going into earnings season and that you have a binary event, meaning a major event that can move the stock significantly in one direction or the other. Soon, immediately after the announcement of earnings is public knowledge, well, usually they drop out of this list. They revert to the mean. Their implied volatility drops down dramatically. Because why? That binary event is now known. It's past history. Speculators have made their bets, either lost or profited, and they exit the position. Because remember what drives the implied volatility? Demand for the options. So what's happening this week that could be considered a binary event? Well, you could argue that the markets are under pressure and put options are being bought by bearish speculators. Call options are being bought by bullish speculators who figure that we're probably going to put in a double bottom setup here. That's not me saying that. I'm kind of bearish. And that we may rally up higher. And or could it be that we had the Fed meeting? I'm willing to bet that, yes, the speculators betting that we have a bottom and other speculators betting that we're going to break to new lower lows, they're certainly driving up the value of options. But the Federal Reserve meeting, now that is going to be a date of interest. And my guess is that this list will decrease dramatically by Thursday afternoon, because the Federal Reserve announces on Wednesday afternoon. So what we did is that we took advantage of the very expensive Goldman options, Meta options. Goldman has implied volatility of 92.69. Remember, any number above 50 is considered expensive. These are nosebleed levels of expensive. And the thing about high implied volatility is that while you read into it that the markets are expecting a big move in one direction or the other, rarely does it live up to that dramatic move. So at some point in time, we are going to revert to the mean. Meta, not too far away from Goldman in terms of being expensive, but I wanted one financial, one tech, just to have a little bit of diversification. Now, we went out to mid to late April on both of these. The reason is that if I'm right, and we should expect to see a deflation, a decrease in the value of the options post Federal Reserve announcement, well, I want to get as much premium as I can now, not just simply go out to Friday for the weekly options and leave money on the table. Now, just because I sold those options going out into mid to late April doesn't mean I'm going to hold them that long. I could close them out maybe if I'm right on my call on Friday afternoon, because the value of the option has declined significantly. And what the implied volatility allowed me to do, the very expensive options, they allowed me to get far away from where the shares are trading at current. Because remember, as option sellers, we don't want to have the shares assigned to us unless we really want them, and then we'll purposely put the strikes close to where we believe we're getting a reasonable discount, and the shares will, in all probability, be assigned to us. If we want to own the shares, we would sell naked puts. If we wanted to get short the shares, we would sell naked calls. So that's the game plan. That's the why behind what we did today. And again, it doesn't necessarily mean that I'm going to hold those positions until expiration. Now let's get to the closing price action of the market. Okay, so last night on Sunday Night Futures Live, I talked about the pump in the futures market and that it would probably carry through if we put in a new higher high on Sunday evening or early Monday morning on the S&P futures. Sure enough, that's exactly what happened. They pumped it up in the morning. They opened the markets up bright green, but we as professional traders understand that we never, ever, ever go chasing the bright green futures. We never go chasing the market up in the morning, especially when you're in a, let's just call this a bear market. Let's just cut to it. It's a bear market. So we never do that because we know that rallies tend to fade. And that's certainly what happened today. Why did it fade? Well, look no further than the 10-year yield. This is the TNX 10-year yield. We skyrocketed today, closing well above the prior highs and right at the highs of the day. This was significant. We knew this was going to happen because we discussed this on the week ahead commentary, that we had broken out. This is a weekly chart. We had broken out and that we expected new higher highs. And this inverted head and shoulders setup is now a full-blown breakout on yields. Yields are going up higher. As for bonds themselves, bonds are tanking. They're cratering. And this is probably going to get worse. Look at the volume here. As for the tips, they're dropping because bond traders believe that, oh boy, yields are rising, therefore that's going to kill inflation. No. No way. No way. So if anything, this pullback is an opportunity to build on positions. Down volume, very light. The U.S. dollar closed down on the day, but closed well off the lows of the day. So we may get higher highs here. Volume, about average. Now, if the dollar rolls over, folks, if bonds are rolling over along with the U.S. dollar, that's a crisis of confidence in the United States. The only reason why I don't think that's going to happen yet is because Europe is an absolute and utter basket case. FXE, that's the euro, the ETF. It closed up today, trying to find a bottom here, but they have a lot of problems over there. Fuel prices are well above what we're paying here in the United States. So as we're headed into recession, so are they. The VIX closed up on the day, but it faded a little bit into the close. But still a bullish chart on price. However, Stokes, weak and getting weaker. I think we're going to get a rally soon. I think it's going to be a post-Fed rally in equities, and we will be backing up the truck as we see extreme oversold opportunities. And I'm going to talk about the ARK fund in a moment. The Dow Transports. A weekday, but they held support. FedEx comes out on Thursday evening reporting earnings. We will be trading that. The Dow Jones daily chart. The indicators remain very weak. They continue to put in lower highs and lower lows. We were up on the day, but we closed well off the highs of the session. So what we're going to do here is simple. Take our crayon out, do one of these numbers. Do we break out or do we break down? We trade the direction the market tells us to trade. If I had to hazard a guess right here, right now, judging by the price action and the momentum indicators, I would have to lay slightly more favorable odds towards a breakdown. The S&P 500. The S&P 500, the Qs, and the small caps are really driving my opinion about where we're headed next year. As I mentioned earlier, we were up on the day early on, reversed to close lower, just off the lows of the day we closed. Either tomorrow or the next day, you're going to have the 50-day moving average cross down below the 200-day moving average. What does that mean? CNBC. They're going to be out there. Death cross. If it bleeds, it leads. So they're going to be talking about this. It'll be negative for sentiment, but usually after you get these death crosses, you get a counter trend rally. And remember that in bear markets, counter trend rallies can be very, very ruthless. So let's buckle up. I think that we're going to see more short-term volatility, but in the coming days, we're going to see a short-term bottom and a rally set up. The Tues, a basket case. New weekly lower lows today, folks. So what we're seeing here are the Tues play catch-up to the small caps. Unfortunately, for small cap buyers, they're ready to break down to new lower lows as well. What's driving that? My guess is that the Chinese stocks that are listed here in the United States, they are getting whacked and magnifying the losses on the small caps. But those names are very oversold as well. So we should see a rally in the next few days. So the Qs, weak on volume, folks. Here are the small caps rolling over yet again on Stokes. We broke the lower band of support today. This is going lower. Maybe they'll limp it back up higher to try to recapture 196. I think it's a short if they try to do that, but I'm not getting the feeling that they will. Now, before we leave IWM, I want to talk about the ARK fund because we will probably be buying it. And I know you're saying, Jesus, you've been hammering Kathy Wood and this fund for weeks now. And yeah, I think she bought horribly. The however is that we have now completely retraced the COVID rally. It's 100% retraced. So we had a significant breakout the week of May the 11th, 2020. We are now down below that level. That makes this interesting because I do not believe that this should have happened. It would not have happened under normal circumstances. Remember what drove this? Lots and lots of government spending financed by the Federal Reserve. We don't have that right now. Not that they're not going to come back and try to pump this back up at some point in time. And when they do, what do you want to own? You want to own this. Now, take note of the weekly Stokes double bottom setup. We're in the second phase of that double bottom setup or a W formation. RSI 22.06. Where do I think that we're headed here? I think we are definitely going to go lower. I think we could see 48.50 per share. That's what I'm looking for. So if it hits that level before the Fed meeting, we're going to be buyers of it. Not quite sure yet. Will it be an options trade? Will it be an outright purchase of the common? Not sure yet, but more to come on that. Daily chart? Yeah, daily chart. This thing wants to go lower. But this is heavily shorted, as are the names inside of this fund. So the short squeeze is just going to be epic. And you may be thinking, what if the Federal Reserve raises rates? Folks, it's expected. It's priced in here. They're going to price it in more. It's expected. Technology really got hammered today. We're on the verge of a real serious breakdown here. Left shoulder, head, right shoulder. We're right at that neckline. We were down on rising volume, but it was still slightly below average. Consumer discretionaries. I've said to avoid this space for a while now. I think this is going to break and break very, very hard. If you're going to need to choose between food, energy, or a latte over at Starbucks, I know it may be a hard decision, but I think most people are going to choose food and energy over that latte. So you want to avoid these names at all costs. By virtue of the fact that the Biden administration will not issue new lease permits, tells you all you need to know. There is a war on the middle and lower classes in this country. Energy gap down today. I think we could still see more of a correction here because remember, we've come a long way very, very quickly. And even if you take a look at a weekly chart, Stokes are rolling over. We rallied 18.33% in the prior two preceding weeks. So it's got to give some of that back. And this is not a leveraged ETF. So it's got to give some of that back. Emerging markets. Remember, EDC is 30% China. China is getting annihilated. And the dollar is rallying, which hurts the emerging market trade. So avoid right now. Gold. Gold, we expected a pullback here. This is no great shock. This is going to be an opportunity. 1940 looks like an interesting price point. If that fails, 1915, 1920. The gold mining stocks, as expected, they pulled back on volume, no less. So expect more selling here in the coming days. NUGT pulled back, broke support on volume. Expect more selling. Silver, same deal here. This is what I was mentioning last night on Sunday Night Futures Live, is that you have boom-bust cycles in commodities. You had a crash up. Now we're getting a pullback and a significant pullback. But is this the end of the rally? No, you need to believe that the Federal Reserve is going to be such a strident foe of inflation that inflation will cease to be a problem within the next couple of years. There's just no hope of that. So this pullback is an opportunity. The silver miners pulling back, held support. They were down on volume, so you're seeing profit taking here. Gold money, same deal here, pulling back, profit taking. Cal-Maine Foods. All right, so we had a nasty sell-off here. What did we do in one day? Everything that we gave up over multiple days, we took back plus some. Now, frankly, Friday's price action did not look like a bottom to me. I thought we would probably consolidate. We didn't. They just took it right back up. So they were waiting to buy the dip, meaning institutions, and they bought the dip. Look at the volume. LABU, utterly annihilated today, down 13% and probably going lower. Look at the volume. Amazing volume today. So I mentioned earlier that I believe that we're going to see 10.75 on LABU before we get a significant counter trend rally. So expect lower lows here. All right, Facebook, I mentioned we opened up a Strangle on. You can't see our put strike here. I'm going to go to a weekly chart to illustrate. All right, so we sold to open, 10 contracts, 165 strike. Simultaneously, we sold to open the 235s up here, the calls, with the probability of profit of around 79.53%. So pretty good odds. And Facebook is probably the cheapest it's been ever. So if those shares are assigned to us, if I choose not to roll the position at 165, I'll take them. Now, the other trade that we put on, Goldman Sachs. Now, initially, I just sold a put here because I thought that with the rising yields, we would see rising financials. You saw a couple of insurance companies do very well today. However, the banks did not do well. So my guess is that the counterparty risk from Russia is still an issue here. So we sold the 260 put. Let's go to the weekly chart because you can't see it on a daily chart. This is how far out of the money we went. 260 put down here. And we also sold a 375 call up here. So we're hedged on this position in either direction. Now, OPTT reported after hours today, and they appear up in the after hours session, which is good. I'm not going to go through financials right now. But OPTT is certainly a potential beneficiary of the energy crisis going on over in Europe. Now, I had a couple of requests to go over. CNA. This is one of those insurers that is a beneficiary of rising yields. Remember how these insurance companies, they make money. They don't make it as much on the premium. They make it on the float. So as interest rates rise, it goes right to their bottom line. So insurance companies love rising yields. So CNA looking rock solid here. It's breaking out. Yields going higher. CNA is going higher. Like it. This is a buy. Pfizer, the Darth Vader of companies nowadays. I do not like this company. I think it's going to roll over. I think there's potential very, very damning headline risk that's going to come out about this company. Longer term, I think that they're going to be lucky to survive, even with their protection by the federal government. Because I don't know if the deal with the government, if there's any type of nefarious behavior that went on behind the scenes, protects their management from criminality. But you never know nowadays. Daily chart, it looks good on a daily time frame. A lot of resistance up here. I wouldn't buy it. I would wait and see whether or not you pull back at a higher low. And frankly, I'd be more prone to bet against it shorter term. Stocks are very overbought. You're probably going to get a pullback. I wouldn't short it with the expectation that you're going to drop like a rock. I just think that we're going to get a short-term pullback here. Then we'll see if anything else develops as the shares put in a lower high. Do we begin to take out new lower lows? Then it becomes interesting as a longer-term short. Not till then. Right now, I definitely wouldn't buy it. IBXT. Maybe it's IDXT. Maybe I wrote it down wrong. Donnie, I think it was you that asked me for these. I'm sorry, but that symbol is not coming up for me. Sorry about that, brother. All right, folks. With that, everybody have a great night, and I will talk to you tomorrow. Be well.